Record the computer. All right. Well, good morning, everybody. And we're here starting day 2 of intermediate accounting. And for those in the classroom today, I passed out the sign-in sheet so you can look at that and just sign your name next. Just sign your name next to your printed name there. There are 2 sections, A01 and A02. For whatever reason, they decided to split these up in terms of on campus and online. But as I mentioned on Tuesday, you have the option of attending however you want to do it, and that's really sort of the benefit of this particular modality. Is the idea you come to class, you can physically attend 10:30 to 11:45 a.m. On Tuesday, Thursday, or you can simply watch it live on Zoom, which we have a couple of people doing that now, or you can watch the recorded video. Now, the video I'm going to upload, it's going to take a little bit of time to upload it because I recorded to the computer as opposed to the cloud, and I can't get back into the room until sometime after another class finishes up, and so there's some processing I need to do in order to upload it, and I'll put it into a YouTube video, which does not require any sort of login or anything like that. So you should be good as far as that goes. Okay, so that's what's going on. One thing I want to talk about here was the schedule for this week, and make sure everyone's in tune with that. We have had a couple of late entrants into the course. This is a pretty full section, which is kind of nice to see. I always like full sections of courses, and so for this week, just complete the orientation assignments. This is easy peasy stuff. Just make sure that you can get into the Connect system. Sometimes there are some issues with getting into it. But we think we've sort of got this where we need it to be. So there's some really easy things to do for the orientation assignments, and then the quiz and homework for this particular week. And week 1 is probably the easiest week of all. I think that's safe to say. It's mostly just an overview of what's going on with intermediate accounting in general, but also with the accounting world more specifically, and where things stand in terms of regulation and oversight and rules and whatnot. And so those are the things that we're going to be really talking about. When we come back next week, we'll start to get into more about what the accounting process is. That is how we record transactions, or not even transactions, economic events. And that's really what is the heart of what this course is about. As I mentioned on Tuesday, we'll be sort of doing a bit of a walk around the financial statements, particularly balance sheet, income statement, and the cash flow statement. I don't think we get too much in the retained earnings statement here, but those are the 4 main statements that we'll be getting into. So anybody have any questions before we get started here about the schedule and what we're doing and whatnot? And if you're on the Zoom link, just you can give me a shout out. It's fine. And we're a small group, and most of us are not live here. And so, but if you want to have a question, just give me a shout. It's no big deal. I'm a pretty informal instructor, so it's not a big situation there. So it looks like we have 1 person live, and we have a number of people in the classroom itself. And again, you are free to choose whatever modality works for you. So I think that we left off last time talking about FASB and what that was. Okay. So, and again, I don't want to spend all that much time on chapter 1 because it really is, something that's easily readable, and it's not particularly complicated, but it does give sort of a background. And I think that's really the important issue here as to what's going on in the accounting profession right now. And so we talk about FASB. It's pronounced FASB. It was created in 1973. It seems incredible it was only as of 1973, but after a couple of success, it was the successor to a couple of other attempts to really standardize accounting. And as I mentioned in the class on Tuesday, that if you look at old financial statements, which I've done before, they're really just a mess, and they don't really conform to any sort of accepted standards and whatnot. And that's really what accounting standards are all about. The key word here is standards. And that is, how do we set standards for how we do financial reporting, particularly in the case of financial accounting to external users. And we're talking here primarily about investors, lenders, regulators, anybody, or really anyone who has interest in what's going on with the private companies that are issuing their securities in the public market. And so that's what FASB is really set up to do. We talked a bit last time, just a little bit about the EITF. And by the way, there's also the International Standards Board. It also has an Emerging Issues Task Force. I think it's not called this exactly, but they are essentially addressing and researching things that are emerging in the accounting world as we speak. And things are changing. And this is what makes accounting interesting. Some of the things that I sort of learned as a young accounting student a long time ago, I've had to sort of unlearn because things have sort of changed a little bit. So, and there are a lot of issues that need to be addressed. And so the task force is set up to do that. Also, the GASB, which is Governmental Accounting Standards Board. I don't teach government accounting, public accounting, that is, and but nonetheless, that is an element of the regulatory concept. So, quick question here: accounting standards in the United States are currently set by a FASB, and we talked a bit about this idea of the hierarchy of regulation, and it really starts with U.S. Congress. Congress and the president, I guess, and we certainly saw Congress get involved in accounting regulation after the 2002 accounting scandals, which were pretty much an earthquake event in the accounting world. With the passage of Sarbanes-Oxley, a lot of changes had to happen in terms of financial reporting. We'll talk intermittently about some of those as we get going. So when we talk about the FASB and standards codification, it is considered the only source of authoritative non-governmental U.S. GAAP. Remember, GAAP is it's the Bible for how we are reporting on events that affect private companies, and then so as a result, U.S. GAAP is the sort of is the framework. We'll talk a bit more about framework here in a minute. And all the thousands of GAAP pronouncements are roughly categorized into 90 accounting topics. And by the way, you can pull up FASB's website. It's fasb.org, and I've got it saved on my desktop. And you just kind of look and see what FASB is up to at the moment, dealing with whatever the current issues of the day are. A few years ago, the big one big question concerned pension accounting, and so for years and years, we were talking about pension accounting. Now, crypto is sort of the big issue. Cryptocurrencies, how to deal with them. We all know they're an asset, but what kind of an asset? Are they cash? Remember, on the top line of the balance sheet, is on the asset side is cash and equivalents, right? Was crypto an equivalent to cash? And so these are questions that are still being sort of worked out, and we could do a lot of time on cryptocurrency, but we won't. So, and we talk about ASUs. ASUs are these updates that the FASB produces that kind of give guidance to accountants and auditors as to how to treat certain issues. And so, and the FASB website is something you can link to. And if you're really interested in sort of, tracking what FASB is doing at the moment, I remember, and we'll talk about the process by which these standards are promulgated a little bit as we get going here. And a lot of times it deals with very controversial subjects, and people have different views as to what to do about certain things. We talk about certain standards. What are the topics? We said we boiled these down to 90 particular topics. I'm sorry, 90, but they kind of have this sort of 100 level codification. General principles, presentation, and it doesn't get more basic: assets, liabilities, equity, which is shareholders' equity. That's balance sheet topics, revenues, expenses, income statement topics, broad transactions, and what is going on within the industry itself. And so if you look at these are how they're sort of codified, and you can certainly pull these up if you like. These are not something we're going to spend a lot of time on unless they impact directly on a particular subject that we'll be talking about here in this class. It is important, I think, we talk a little bit about the international scene. I talked a bit on Tuesday about international accounting standards, and the fact is that we've really got two systems of accounting standard setting throughout the world. We have GAAP, which is produced by the Financial Accounting Standards Board, and we have what is called IFRS, or IFRS, that is produced by the International Accounting Standards Board, which is the successor organization to the International Accounting Standards Committee. Okay, so since 2001, we have the IASB. So we have FASB in the US, IASB, which is still based in London, and they produce standards which are called IFRS. And so if you think about it this way, think about FASB, oops, the pen doesn't work. So in the U.S., we have FASB, which is the promulgator of standards in the U.S., and those standards are simply codified in what we call GAAP accounting. And we have the IASB, which is the international body based in London, but it incorporates most of the rest of the world. And those standards are called IFRS, that is International Financial Reporting Standards. Now, I don't know how much we're really going to spend time talking about the international standards. If you take more advanced accounting classes, you will certainly get into these. There are some differences, and they're pretty important differences. And I think in my mind, probably the biggest difference is asset valuation and in particular inventory, which in the international standards, the LIFO system is disallowed, and in some ways that might be a smart idea. And we'll spend a lot of time talking about LIFO as we get going in this course. But LIFO, which is the last in, first out methodology of inventory valuation, is disallowed there, and for good reasons. And it would be, I think, difficult in this country to disentangle companies from their use of LIFO to go back to something like FIFO or average cost or something like that. I think it would be a nightmare to do. And so I think that's kind of the issue that it really sort of plagues these the two differences. But there are some other differences as well. So brief comparison here, you have GAAP, which is US, and everyone else. And the monitoring board is the SEC. The monitoring board is essentially based in Europe, and it monitors countries that use this particular standard, that is the IFRS standards. Financial Accounting Foundation. By the way, both of these entities have foundations, which are private entities which sort of control these regulatory bodies. And the IASB is essentially funded and supported really by the Financial Accounting Foundation in the U.S. And the idea is, if we're going to have different standards, let's at least have two different standards as opposed to multiple standards around the world. So that's kind of what's going on there. So we have FASB, which is the standard setting board, the IASB, which is the counterpart to FASB in the rest of the world. You've got the membership here, and you've got Emerging Issues Task Force, which we talked a bit about earlier. So real quickly, because I don't think it's terribly critical that we talk a lot about the international standards. If you take advanced accounting, you'll probably get much more into this. And I don't want to minimize the importance of the international standards, particularly since we typically train accountants to work for big companies, not always. Sometimes they may work for governments or smaller businesses and whatnot, but bigger companies tend to have international presences. And so as a result, they have to adhere to these particular standards. And so since 2001, IASB has revised a lot of their standards and issued new standards, and we simply now call them IFRS. And more countries are using these, and most of the countries in the world are really on those standards. So you might think, well, what's wrong with the U.S.? Well, there's nothing wrong with the U.S., except for the fact that our standards sort of developed prior to a lot of the international standards. And as a result, it becomes a little bit difficult to sort of, change horses in midstream, if you like. And there were efforts, and I remember, particularly in the late 90s, there was a lot of sort of optimism about the idea that US GAAP and IFRS standards would converge to have one worldwide standard as to how we report transactions, revenue recognition, asset valuation, all these kind of things. And so the story that I've heard more than once is the idea that after the 9/11 terrorist attacks, there was sort of a focus on other things, and this was sort of put back on the back burner because keep in mind that the ultimate regulatory authority is going to be U.S. Congress, which is elected officials and also regulators in this country. And after the 9/11 attacks, there were other fish to fry, if you like. And so it never really happened. And so it doesn't look like it's going to be achievable. In fact, the slide package itself says it will not be achieved in the foreseeable future. And I don't think it will. And is that a problem? Well, it complicates life, particularly for those who are preparing financial statements for companies that do business across international lines, which is a lot of companies. So it is a complicating factor, but there is work going on in order to standardize certain things. And certain aspects can be reconciled. Again, I come back to the inventory issue, which we'll talk much more about. It's one of the things that seems to me to be one of the big sort of deal breakers as to how and why this is not going to necessarily happen. I don't want to go through all these slides because I know you can all read and go through these, but there is a standard setting process, and the process is it's not a dictatorial sort of system. There's participation from the private sector, and in particular, this idea of analyzing comment letters and public comments. And I remember it's probably been, oh gosh, 20, 25 years ago, where there was a recommended change. FASB was going to come up with a standard for pension valuation. It's called actuarial present value. And the business world just went crazy. They said, we can't do this. We don't want to do this. It's going to be complicated and whatnot. And there was a lot of pushback against FASB. And as a result, FASB sort of backed off on that. And whether they should have or not is really a subjective judgment. But the idea is that it is open to some public comment, and particularly from those who have interest in what is happening with regard to accounting standards. Okay. And obviously, politics are an issue, and since the 90s, some of the big issues were things like stock options. I'm pretty intimately familiar with stock options, being mostly a tax accountant, and there are different kinds of stock options, and the valuation of those and the treatment of those is really important, particularly from a tax standpoint. And tax is really not a major focus of this course, but the idea is that stock options and all the various things like restricted stock units and all these other twists on employee compensation and deferred compensation are all things that that the government's trying to deal with. I almost said IRS, but because I'm sort of a tax guy, but FASB was trying to deal with, but the IRS was also dealing with. And also the issue of fair value accounting. We'll talk a bit more about fair value. And fair value accounting is sort of a thread that kind of runs through all of accounting when it comes particularly to how we value assets and what some of the issues are and some of the problems that come about from that. And one of the problems that we saw, certainly, and I'll get to this here in a second, is some bank failures of about 3 years ago, I think, where fair value accounting actually sort of maybe contributed to some difficulties with particular banks. And we don't want banks to have, sort of wobbly finances, okay? Also, there are politics involved in international standard setting. And we think of the IASB, I think we think of it a lot of times as a European organization. It's not really, because it's sort of global, but the EU, which is sort of the federation of independent countries in Europe, we really think of the IASB as sort of a European organization. The European economy together is larger than the US economy, but individual countries are not. But they definitely have an outsized role, particularly given the fact that it's not just the EU that are members of this. And so politics are always involved. And of course, the famous statement here about accounting being too important to be left to accountants. You could say that about pretty much any occupation, I think. Engineering is too important to be left to engineers or whatever. So what is the issue with regard to reporting? We want high value and high quality reporting. Now, there's a lot of linkage between what we're doing here in intermediate accounting and that of auditing, which most of our students are probably not taking yet. But CPAs provide audit services to companies, and as a result, they're trying to apply GAAP to the reporting that is offered by the companies themselves, who are their clients. And so the role of an auditor is to offer credibility. It's basically to put a stamp of approval on these financial statements. And where some of the troubles began back in the early 2000s were the idea that the companies themselves, that is the clients, were exerting a lot of pressure, I guess we could say, on the accounting firms themselves to sign off on valuations that weren't realistic. Enron is just a classic example of a case where accounting has just gone off the rails. And there are a couple of great books on this, and I can sort of point you to them if you like accounting thrillers. And I know that's not exactly a genre of literature, but as to what went wrong with Enron and their auditing firm, Arthur Andersen, which it no longer exists because the entire problems with that one company brought the entire accounting firm down, and that was the place that a lot of accountants who graduated from business schools wanted to go to, and that company no longer exists. And so that's a bit of a problem. So the accounting scandals of the early 2000s. This was really I was teaching at a business school at the time, and I was just leaving the banking industry, but all this started to sort of come up. Enron is the classic case, and there's a book called Conspiracy of Fools by Kurt Eichenwald, if you want to read that. It'll if you're really into accounting, it'll shock you as to what some of the things that Enron wanted to do and how they wanted to do the accounting treatment. And this was a real company that made real products. It was a power company, and they kind of went off the rails. And they were aided and abetted by their accounting firm. And since then, the Sarbanes-Oxley Act, which we call SOX as an abbreviation, did a lot of things in order to sort of make this a little bit more realistic in terms of credibility. I think that's really the key word. One of the things that it did was require the CEO and CFO, that is Chief Executive Officer and Chief Financial Officer, to both sign off on financial statements individually, personally, with their own personal stake on the line, saying these statements are accurate. And we have also evaluated internal controls within the organizations. And we are saying that we are satisfied that what we're representing to the world, because we're public companies, is accurate information. But there were some problems. Now, I don't know much about the Xerox issue, but WorldCom, so the WorldCom example was, it was so elementary and so basic. It's almost like nobody saw it coming, because it was such a ridiculously elementary fabrication of expenses, which were capitalized, that should not have been. And I think people weren't really looking for it. I just don't think anybody thought that anybody would do something so brazen. And we're not saying that expenses shouldn't be capitalized, because there are a lot of expenses that can be capitalized. Inventory is a big one, right? All inventory is capitalized as an asset until it's sold. But they were taking things like, normal expenses and putting them on the balance sheet, which was a complete fabrication, and that was really an egregious issue. So the bottom line is that if you don't take care of your own business, someone's going to take care of it for you. And unfortunately, the accounting profession had to kind of deal with these kind of things. And I don't mean to suggest that everyone in the accounting profession was complicit, or even anybody involved in auditing of public companies were all complicit. It was just some outliers that were sort of pushing the envelope. And envelope pushing is not anything that's new. It really is. I remember when I took my first tax accounting course years ago. It was I went to Indiana University, and a very good business school, and they were saying that good tax accountants push the envelope, and they were very overt about that. Don't break the law, but push the envelope and serve your client. And today I don't know that we have that, particularly among those of us who are academic accountants. I don't know that we sort of push that on to accounting students today. I just don't think we do, and I don't think it's ethical for us to do it. So what are some of the key provisions of SARBOX? And so oversight board, which is required for public companies. This idea of CEO and CFO signing off, and also one big one is the idea of auditor rotation, and that's the idea that they have to change auditing firms every, I believe it's 5 years. And so if you're a very big company, you're going to be moving these auditing firms around. And so in order to prevent too cozy of a relationship, and I think that's essentially what some of the objectives of that particular motivation are. Okay. All right. Any questions so far about what we're doing here? Okay. Again, when we come back next week, we'll talk more about getting into some of the meat and bones of what's going on with financial accounting. But we're just going to cover some of the outlines here. And one of these broad outlines, which really concerns, I think, the difference between U.S. GAAP and international standards, is this idea of what's called principles-based accounting versus rules-based accounting. And one of the things that we can say about principles-based, or let's take rules-based first. So in the U.S., and I think this is important for us to understand, particularly as we decide how to do accounting treatment, is where did GAAP really originate from? And it came about because of a lot of chaos, frankly, in financial reporting and leading up to the Great Depression. I know your text, I think, has some language about the stock market crash, sort of forcing, a more rules-based system. Yes, that was one of the factors, certainly. But it was just this general idea that there were no rules, and so people were kind of doing what they want. It was the Wild West of accounting. And as I mentioned in class on Tuesday, if you look at some of the old financial statements, to the extent that they still exist, it's just really ridiculous the way that, I mean, you really have to sort of drill down into it to find out what the heck is going on. And there's no assurance even that the numbers are correct. Are they audited? Are they checked? Are there tests that are being done that auditors will tend to do? And so as a result, there need to be some sort of rules. And the US really, as one of the very first industrialized economies, decided that we needed some sort of rules. And so GAAP accounting is based upon a rules-based system. How does this differ from a principles-based system? The principles-based system is based more on how are we reflecting accurately what's going on within a particular company. And it's a standard setting that uses judgment really, as opposed to just simple rules that are set in stone and put in place. Now, I will admit that I do prefer a principles-based approach, and I know that I've long been known as being one who admires the international standards in a lot of different ways, and it doesn't make me anti-American, I don't think, but it does point to the idea that principles-based accounting is, and we'll talk much more about this as we get going, is based upon the idea of, well, what is the actual value of something? And I'll give you an example, because I taught 2110, for a long time, and which is the introduction to accounting. But when I was the first, I guess, real job I had after college, I worked for a bank, and we had and I've said this many times before, so if you've heard it before, I apologize. But we had a property that the bank I worked for was founded in 1857, and they had property right downtown Indianapolis. That was about an acre, and it was valued at cost at $1,500. And by the time I got there, back in the 1980s, that property was worth tens of millions of dollars, but we were still carrying it on the books at cost. Does that make sense? Is that because the rule is based upon cost? Does that make sense, right? Or should we adjust that value to reflect more of what the actual value is? And there's a passionate argument on both sides. There are people who believe in this idea of cost accounting or of cost basis as being the sort of standard we ought to go by, because it's arm's length transactions, and it's where the rubber hits the road. Principles, well, we don't really know what the value of something is. Whoever's subjective judgment prevails. But I think that's one extreme example. And I know that the only reason this came up was because we were being bought by another company, and they were saying, look, this is the value, this is the book value of your company, but we're saying, look, we've got a piece of property that we own, the land, which is worth many, 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 many times more than what it was paid for. And so you get the idea that rules can sometimes hamstring evaluation. And we'll talk a bit more about asset valuation. We'll also talk more about fair value accounting as we get going. Okay. Any questions? I'm going kind of quickly here, and I know I am, but I kind of want to get through at least the vast majority of this so that we can come back next week and start to get into the heart of the course. But one of the things we should talk about, and we have to talk about, in fact, our accrediting bodies require us to talk about, is ethics in reporting, particularly accounting ethics. And we have a number of different professional organizations that regulate the accounting profession. The biggest one is the AICPA, which if for those of you who are interested in taking the CPA exam, they actually create the CPA exam, and you become a member, or even if you're not a CPA, you can still become an affiliate member and whatnot. But they sort of promulgate the rules of professional conduct. And they also work very closely with state licensing boards. All CPAs are licensed by states. Enrolled agents, like what I did back in the day, or registered by the Fed, or licensed by the federal government, but CPAs are licensed by states. IMA, which is Institute of Management Accountants, that deals more with those who are remember, accounting is sort of broken into two very broad branches: financial accounting and managerial accounting. Managerial accounting, their main licensing authority is the Institute of Management Accountants, and there's a CMA exam that people do take. There's also the Institute of Internal Auditors that is for those who are interested in auditing, and you can become a CIA, a certified internal auditor. And those are professional organizations. And they sort of set the codes of conduct for how people are to conduct themselves. You can easily get, waylaid in terms of your career if you violate some codes of conduct. And if the state doesn't take action against you, maybe the licensing bodies do. It's not something you want to mess with. Being disbarred is not just a thing for lawyers; it's also a thing for accountants. So don't get disbarred is the issue here. So there's a model for ethical decisions, and I'm not going to go through this in a lot of detail because I know you can all sort of read this, but it's this idea of how we sequentially make decisions based upon what the ethical issue is. And one of the things I should say, and I know we talked a lot about this idea of accounting scandals in the early 2000s, but my experience, and I've been in the business world for a long time now, is that most accountants are very ethical and very scrupulous and tend to take a conservative approach to valuations and reporting and not exaggerating and overstating and whatnot. That's been my experience for a very, very long time. Yes, we know we have these outliers like Enron and WorldCom, but for the most part, most accountants are really dedicated to this idea of ethical decision making. And like, this is what attracts me, among a lot of other things, to the accounting profession. Is it's a very ethical profession, and people are really committed to it. And there are times in which there are agonizing decisions as to how we do things. And I can remember in the business when I was in the corporate world, where sometimes we really didn't know how to treat things. I remember our CFO who was sort of struggling with how to report something, and he wanted to take the right approach, but it wasn't clear, and there were a lot of gray areas, and that's part of the thing that as a business, I mean, beyond being an accounting instructor, I'm also a business school instructor. One thing I can tell you is that there are a lot of times in the business world where you just don't know what the right answer is. You just don't know what the right approach is, and it's not always black or white. It's sometimes very different shades of gray, but this is a framework. It's a model for decision making that should lead accountants to make better decisions based upon ethical considerations. Okay. All right. Quick concept check. High quality financial reporting. Well, which of the following is not one of the ways in which high quality accounting is assessed? And the answer is D. Managers are required to use frameworks for ethical decision making. Well, they're not really. They're useful, but there's no requirement for managers to do that, particularly non-accounting managers. And when we talk about non-accounting managers, we're talking about typically a lot of other areas of the company that do not have this particular background. A lot of people who go into public corporations do not maybe take a couple of accounting courses. That's it, and we can't expect them to have the same sort of in-depth knowledge of accounting standards as those of us who have studied this a little bit more. So. All right, so this is the conceptual framework. Now, this is really, I think, in my opinion, this is the heart of this chapter. To me, this is the most important piece. And so kind of read this, make sure you understand this, because this is really sort of the background to a lot of what we're doing in financial accounting in general. It's something called the conceptual framework. What's interesting about the conceptual framework is if you Google the term, you'll get all kinds of different definitions, and because it doesn't just apply to accounting, it can apply to a lot of other areas of study. But one of the best definitions I said is it's a way of viewing, and a way of viewing, which I thought was a very, very simple way of understanding a conceptual framework. How do we view accounting, particularly U.S. GAAP, right? And so the conceptual framework basically lays out the sort of theoretical and logical sort of outline of how we're to do our work in the accounting profession, right? So it guides the selection of events, how we measure those, how we communicate those, and all that. It also gives, and I like this, I probably should have underlined this, structure and direction, because in other words, the one definition I saw, the way of viewing, I think makes a lot of sense. But also, what do we do with it, right? How do we proceed? And we all have to be on sort of the same page here as to what's going on, right? So if you're an ambulance operator, right, I think the conceptual framework there is to save the patient and to do whatever is good for the patient, right? It's not to do whatever else is maybe tangential to that. That's it's the underlying outline of what the work to be done is. And so in a conceptual framework in accounting, we're trying to summarize events, and a lot of it's historical, right? We're talking about measurement events. We're not talking about forward-looking sorts of things necessarily, but what happened in the past, in the recent past, so we can communicate it to those external users who are interested in what is going on, okay? Now, in managerial accounting, we talk a lot about future-oriented events where we say, okay, if we do this, what do we expect to earn in the next fiscal year or whatever? Well, that's not quite the same thing, and that's why managerial accounting, among other reasons, are different from financial accounting, and it's the idea of what is the framework that we're trying to deal with. And so the framework here is we're trying to do accurate reporting that is free from bias and all these other things. And we're going to get to some of these topics here now. And that is the conceptual framework. So I don't know, this is probably not the best graph I've ever seen before, but it kind of tells you what the objectives are. And we're going to focus a little bit on, the elements, which are basically those major categories of reporting that we see on the major financial statements, balance sheet, income statement, et cetera. And so what are the qualitative characteristics that feed into this? There are some constraints, but ultimately the goal is to produce financial statements. And all this sort of feeds in to the bottom here. That's we're trying to create financial statements. That's what financial accounting is financial reporting at the end of the day. But there's an objective, that's to use these elements and to try to factor in all these other characteristics that allow us to accurately report what is going on with the company, knowing that there's going to be some error and we're going to be off a little bit. And there are things like material objects that are sometimes dropped, but we'll talk a bit more about it. So when we talk about the conceptual framework, this is a big paragraph. I'm not going to read this in all, but the conceptual framework are similar between GAAP and the IFRS standards, and they're converging more and more. However, we're talking more about in GAAP, the conceptual framework primarily serves to provide as a guidepost for standard setters in order for them to do whatever it is they're doing. In the international standards, they're much more interested in principles-based accounting, where there's an idea of the fair presentation and fair value accounting, which is really, I think, probably the biggest difference between the two. I'm not being critical of either one. They are both important. It would be nice if they converged and formed one worldwide system. I'm probably not going to live that long. Maybe you will. I don't know, but we're probably not going to see that anytime soon. So what is the objective of financial reporting? Well, is to produce high quality statements, and there are some qualitative issues and also some constraints that limit our ability to do those. And so let's talk a bit about this idea of usefulness. These little boxes here are all terms that are used all the time by accountants, and when I say they're used all the time, they really are. I mean, we hear things like materiality. Is it material? I can't tell you the number of times, particularly as a tax accountant, in which somebody said, "Oh, I forgot to include something on a return," but it wasn't material. It was $100. Somebody got as a sort of a gratuity and whatnot, and so if it's not material, I didn't include it and whatnot. Materiality is really a very subjective test of the idea of is something important enough to report, and there are certain tests, and we can drill down into that and get a little bit more specific as to how those tests are achieved and whatnot. But also relevance and faithful representation. These are the big issues here. Is the information relevant? Do we want to include information that is not particularly relevant on a statement? Now, we'll talk a lot about notes to financial statements, which are something that I think a lot of users don't bother to read. It is sort of fine print. I can tell you financial analysts do read these, and they are, because it really, in my mind, they tell a lot more about what's going on than simply the numbers presented on the balance sheet and income statement and whatnot. And that is what things are going on in the background. How do we produce these numbers? Keep in mind, too, that a lot of public companies report on what's called a consolidated financial statement basis, where they're sort of lumping together all their operations worldwide, and different kinds of companies, different kinds of industries and whatnot. And sometimes they'll split these out very specifically as to what's going on with, this particular operation. I mean, Paramount at one time owned part of Coca-Cola, and so they were a movie company, a film production company, they were a soft drink company. I mean, these were not industries that go together. And so you get the idea of how do you express what's going on? How do you split these out to the extent that one wants to do that? And a lot of companies over time have sort of not wanted to break out the details of individual subsidiaries, mostly because they don't want competitors to know exactly what's going on. And so this is an area that is it's an issue that's been going on for a long time. But predictive value, confirmatory value, materiality is a big one. All these are issues concerning relevance. And so it allows the user then to comparability and verifiability. Comparability is this idea of, are we being consistent over time? And are we using the same sort of methods? And also to compare across industries, and that is particularly against competitors. And this is done all the time. I know we did it when I was in the business world, where we looked at our competitors' financial statements to try to find out what they're doing, where they're being successful, and where we have shortcomings that we could do better because of our analysis of what the competitor is doing. And so comparability is that issue. Verifiability, timeliness, is it produced on a timely basis? One of the problems that we have, and which is why quarterly statements are required for public companies, but one of the things that is difficult is if you have, let's say, a fiscal year that ends on December 31st, you've got information that you're going to report sometime, I don't know, by March, April of the next year, and you're going back all the way back to January the prior year to some of the events. Is that really timely? And so as a result, this is why quarterly statements are required, what we call 10Qs that are reported in this regard, to kind of give users a little bit of an update as to what's going on. And one of the biggest users is the financial community, which is more than any other industry I can think of, interested in drilling down into these statements to find out what the heck is going on, and understanding how they're treating certain things, why they did what they did, why are they deferring certain things, whatever, right? Also, some of the other is completeness, neutrality, free from error. You can read all of this, but the idea is to try to present to users a coherent story, and I know that there's a problem with the fact that sometimes these are very complex statements to read. And I know that I've certainly seen my share of financial statements that you look at the notes and think, what? What are they talking about, right? Particularly as it gets to things like pension accounting and whatnot. It's difficult. And for the average person who's an average investor, I think it's a real challenge. And it's not something that's easily overcome, even though we strive for the goal of understandability. It's not always that easy, because there's only so many ways you can sort of present, something like a loss provision or an impairment or whatever, right? Okay, so concept check, FASB relevance is what? Which of the following is not a component of relevance? Well, free from error, materiality, confirmatory value, predictive value. Well, it's going to be A, free from error. That's an element of faithful representation, and you can always look back to this particular slide if you want. All the work in this course is open book, so you have that available too. But I don't know if this is a particularly important issue, but as to how it's categorized, other than the fact that it is a thing. Okay, so it's something to be thought about. Which of the following is not a component of faithful representation? And the answer here is the idea of understandability. That really is an element of usefulness. So yeah, you can kind of look at that. Those are not areas that I want to spend a lot of time on in terms of where they fit on the outline here. But what I do want to talk about are the elements. And this is where this course really is sort of built upon, is the idea of the elements of financial statements. And these elements are pretty basic. They're ones we've probably you've heard of before, you've certainly heard of before. And there's things like assets, pretty basic, liabilities, stockholders' equity, investments, distributions like dividends, cash dividends, stock dividends, whatnot. Comprehensive income we'll talk a bit about, and I think we also get into that a little bit in intermediate 2. Comprehensive income is the sort of the bottom line that are away from operating activities, but nonetheless affect income statements, and then the accumulation of those is also reflected in stockholders' equity. And so comprehensive income, which we sometimes call other comprehensive income, is going to be talked about. Revenues and expenses, gains and losses, those are all income statement items. And again, gains and losses are non-operating issues where we sell an asset at a gain or a loss, or we dispose of it at a gain or a loss. And so as a result, these are not related to our normal course of doing business. It's just, but something has to be accounted for. Okay. All right. Any questions? And I'm going a little bit quickly here. I apologize for that, but let's talk a bit about underlying assumptions. And that is, these are things that I'm sure we talked about these in 2110, which is really the intro to financial accounting. And we talk about economic entity assumption. That is that we can sort of wall off and define a particular economic entity, corporation or subsidiary or whatever, but we can certainly define the parameters, the boundaries by which that operating entity is existing, and we can do the accounting for that. Also, going concern, this is an area, it's controversial, and it's been controversial now for some time. In fact, but when I was coming up in the business world, it was almost given as sort of something that's going to be here forever, and that's the idea that business will continue to operate forever. I think that's not a very good assumption, because a lot of businesses get bought by other businesses, and so they cease to exist in that regard, or they fail, they go out of business, and that is it's a reality. And I think that we need to really sort of modify this a little bit. However, having said all that, the fact that businesses are probably going to end at some point, we still need to assume that they're going to operate indefinitely, that they're not going to have a limited life. There are entities out there that do have a limited life, and I'm thinking about limited partnerships in particular, where it's project financing for a particular thing that's going to wrap up at some point, the whole thing is going to go away, right? But for the most part, when we talk about publicly traded companies, we're going on the going concern principle. By the way, about a year ago or so, Jeff Bezos, the founder of Amazon, said at one, and it kind of freaked some people out. He said that Amazon will at some point go out of business. And we think of Amazon as this giant behemoth, and they are, right? But I think he was just being realistic, saying at some point we will probably cease to exist. And so as a result, nothing is forever. But we assume, at least in the very short run, that entities are going to survive for a long period of time. Periodicity is the idea that we can divide time units into measurable units. Quarters and years are really what we're talking about here. And they could be artificial. That is, we can have a year end that's March 31st, or some companies will have some, well, they want to try to sort of capture the major, if there's cyclicality, they want to sort of capture that within that particular year. So if you're a retailer, you probably pick a year end. It's going to be sometime maybe mid-January after returns are back in, so you can match returns with sales for holiday shopping. So you may have a year end of January 7th or something like that. So it's artificial, and but it's only artificial in the sense that it makes sense for the particular entity. And so there is no real requirement as to what fiscal year is set up. I know a lot of the companies that I used to work for had just simply a January 1st to December 31st calendar year. The calendar year became the fiscal year, but not always. And so as a result, we have to be aware of that. The monetary unit, this is something important, and it becomes a bigger issue when we get into international accounting, where you've got sales in different currencies. And if you're a company that does business overseas, you're going to sell in euros, you're going to sell in yen, and all the other sorts of things. But you will have to convert that back to US dollars if you're reporting as a regulated entity in the US. So in other words, if you're SEC recognized as a publicly traded company, you'll have to convert those back. And that's a challenge. It's not always easy to do. It's actually kind of a specialized area that people have to sort of deal with. Also, recognition of measurement concepts. I'm not going to spend a lot of time here because we're going to get into this a lot in this course. And that's the idea of how do we recognize things as events that need to be recorded. Not everything that happens, and I know we talked a bit about this in 2110, not every economic event that happens is reportable. If somebody is simply wanting a quote on a particular job, that's not a recordable event. There's no transaction that's happened, right? So when do we recognize revenue and expense in particular? And revenue recognition and expense recognition are very major highlights of this course. When do we record those, and how do we record those? based upon what sort of techniques. And those are a lot of what we're going to be doing here. And the measurement of these is also how we sort of put dollar figures on those. And disclosure is simply based upon the idea of how we include additional information that supports what's going on. Keep in mind, this is a lot of written information, and the notes, and I've talked about the notes before. This is something a lot of people just kind of look at the numbers, they just kind of skip over the notes, thinking it's like fine print. And we're sort of deluged in our society with fine print, aren't we? I get a prescription from CVS, right, for my asthma, and I get this gigantic printout, and I don't read it. First of all, I wouldn't understand it, but it's there. It's being disclosed, and I guess it's my job to know it. But I don't read it. A lot of people don't read fine print. However, we are in the fine print business. We really are. Whether you like it or not, we're in the fine print business in financial reporting, because a lot of the notes contain a lot of information about what's going on. In particular, things like lawsuits. And I've talked a lot about this in other courses. Most public companies are involved in litigation at some point, either as a defendant or as a plaintiff, or maybe as a criminal defendant, which is not good. But a lot of companies are involved in this, and they have to really disclose what's going on, what is happening here. By the way, I did about a couple of years ago. I did a big deep dive in Kroger, which one of their subsidiaries here in New Mexico is Smith's. And New Mexico is one of the first states to settle an opioid lawsuit against all these retailers that were selling drugs that were addictive. And we could argue over the merits of the case and whatnot, but nonetheless, that was all sort of disclosed in the financial statement, saying, look, we've settled with the state of New Mexico. We have other states that are suing us because we're dispensing these drugs, which are making their way in the hands of people they shouldn't get there, and whatnot. So, but it's a pretty big thing. It's not, and you don't think of a grocery store as being involved in litigation of that sort, but that's kind of an idea of where this disclosure of material facts that people would need to know in order to make decisions is represented there. Okay, and also this idea of relevance, reliability, and all that. Remember, the reporting, when it comes to the numbers themselves, they've got to be measurable, they've got to be verifiable, they've got to be reliable. People do rely upon them, and so it's really incumbent upon the accountants in order to present information that's reliable. Okay, all right. I talked a second ago about revenue recognition. This is going to be an important topic. We'll be talking about this a bit more as we get going. The term revenue itself, it's one that should seem obvious, but there's a very wonky definition, and it's an inflow of an asset or a settlement of a liability. Now, that's a little bit less common. Settlement of a liability, usually it's an inflow of asset, usually cash, right, to sell something to somebody else, right? And whatever it's product or service, right? And the issue of settling a liability, that's much less common, but it has the same material effect on the balance sheet and an income statement as a result of that. But it's inflow of an asset, and that's something that we don't really think about. We think of revenue as being I sell something to somebody, I collect cash, or I post a receivable, but I'm ultimately going to convert it to cash at some point. But it's any asset that is in the normal course of doing business that is really a revenue. And we have revenue realization. That is, we have to say that the earnings process is based upon these two characteristics. Number one, it's judged to be complete or almost complete. That is, we have earned the revenue for whatever it is we've done for some of the customer, right? And there's a reasonable certainty as to the collectability of that. If there is not reasonable certainty, we have to make an adjustment for that. But nonetheless, if there's reasonable certainty we will be paid for it, then that is what qualifies as revenue. And there's something called ASU, and this stands for Accounting Standards Updates. And I don't know if we even talked about this on Tuesday, but these are things that the FASB issues on a periodic basis. And they, you have the year, and then there's a number that comes after that. And you can simply pull up the FASB website to see what they're working on. And they're usually provided to give very current, updated information so that accountants can know how to treat certain things, right? So recognizing revenue when goods are transferred to customers, goods or services. And by the way, services have for a very long time been growing much faster than physical products. And so this makes it a little bit more complicated as to when have I delivered the product if it's a service. It's one thing to ship a physical good, that from Boston to Philadelphia, and so it lands on someone's dock and it's there. But what about service? When have I completed the service? And when is it done? And when have I earned the revenue? It's a little bit more challenging, and so this is why revenue recognition is sort of a big issue. And likewise, the other side of the equation is expense recognition, and we try our best in the accounting world to match revenues and expenses, particularly within the same time frame. And but how do we do it? It's not always as straightforward as what it might seem. There's got to be some sort of cause and effect thing going on, and we want to associate, or what we call match, the expense with the revenue in that particular time period, even though the cash may move at different times. We talked a bit about this on Tuesday. We also talked about in 2110. The money moving back and forth is not really the issue. It's the economic event that's happening here that we want to sort of match up one with the other. Okay, matching expenses and revenues is very important to do, and within the same time period. Okay, regardless of when cash flows happen, yes, cash flows are important, and if you're selling a product, yes, you do want to be paid for the product, but and if you don't expect to be paid, that's a whole other issue as well. But that's really what's going on here. So, all right. So from here we go to this idea of measurement. This is one of the one of the sort of principles that are enumerated on the prior slide, and that is something called historical cost. Historical cost is got its limitations, and I talked a bit about that a second ago. But nonetheless, the idea is that we particularly put assets as well as liabilities at their original value, that is the initial cost of those particular things, and we carry them, and they can be adjusted for depreciation and amortization, right? Depreciation is simply a cost allocation method, particularly for long-term assets, right? Well, not particularly, almost exclusively for long-term assets. Amortization, though, is more dealing with intangible assets of a non-physical nature. Things like patents and whatnot can be amortized because we know that they have a limited life, and so as a result, we're bringing the value of those things down. But we put them on the books at their initial historical cost, and we have usually a contra account of accumulated depreciation, accumulated amortization that sort of shows where the historical accumulation of cost allocation is over time. Net realizable value, which is essentially what can we expect to get for a particular asset now if we had to sell it, right? And so we typically put things on the books at cost or net realizable value, whichever is less. And if the net realizable value has fallen, then we need to make an adjustment for that. And we'll talk a bit about impairments as we get going. And there's the idea that some assets don't have the life maybe we thought they did, or they're not worth what they thought they were. And these things happen. It's something that happens. And so net realizable value is the idea of more of the fair value concept of bringing things down to their current level. Current cost, what would it be to purchase the asset? I'm going to come back to this a little bit because we'll talk about some of the tests by which we put a valuation on an asset. Present value and future, and present value is this idea of discounting future cash flows. This is used a lot, particularly in the financial world, of saying, okay, this is the expected cash flows we're going to get from whatever it is, the project we're doing, right? We're going to buy a subsidiary. This is the amount of cash flows we expect, but some of it's going to be over a time period in the distant future. And obviously, as one of the main concepts in business math and accounting is the idea that a dollar available today is worth more than a dollar in the future because it's not available to you until the future. So we have to discount that value, and we discount using some discount rate, some percentage that should be relevant to the particular project at hand. We talk about fair value. Fair value is the price that we could sell an asset in what we would call an arm's length exchange between unrelated parties. If I sell you a good, what is that particular good worth? Fair value accounting, we will talk a bit more about. It has a lot to do, particularly with accounting for liquid assets, where there's a change in those, and they are. Excuse me, stocks and bonds, they fluctuate, and it's really difficult to say that if I paid $500 for a stock that I bought on March 1st, it's worth now $700. It kind of still represented at $500. Well, that's a question. That's why fair value accounting is what it is, and it's how do we adjust and be, with faithful representation, present an accurate view of what's happening. Okay, historical cost is based upon some original value way back in the day. It could be way back. And unfortunately, a lot of the assets that are on the books of companies do not go way back. And in fact, I told the story about our company that had the $1,500 acre of land right downtown in Indianapolis, which was worth many more times. What they ended up doing was creating a separate subsidiary that they transferred the asset to, and were therefore able to step up the value of the asset. Pretty neat accounting trick, right? And particularly since they had different owners than the company itself, and we simply leased back that land. That's one way to do it, right? Most assets are not that long lived. Excuse me, but you get the idea that the original cost basis is how we typically value balance sheet items. Okay, and when it comes to assets, it's obviously what the cash value was as initial acquisition, whenever that was, and for liabilities, it's whatever the cash equivalent was when it was done. And there are some exceptions for long-lived assets, and that is they're adjusted subsequent for recognized depreciation or amortization. I'm sorry, I'm gonna get an allergy here. So, and then as we write down the value of these, we still keep the original acquisition value on the books, but we are adjusting it downward. Depreciation and amortization are simply cost allocation measures where we're taking the value of long-lived assets, which are really prepaid, frankly, and we're spreading out the cost over some estimated useful life. In the case of depreciation, estimated useful life, whatever that is, then we could be wrong. We may be wrong, right? In the case of intangibles, and we're amortizing, it's probably going to be a little bit more concrete and a little bit more easily able to represent that. Okay, any questions? Let me. I'm sorry if I'm neglecting the Zoom. You can put in any kind of. I should check periodically for any kind of comments because sometimes people put comments in the chat pad. So I got to be mindful of that, and I apologize if I'm not being mindful of that. So, but feel free if you're on the Zoom call or whatever, just to shout out. We can hear you. We actually have microphones here. It kind of freaks people out. And people start talking from some other distant place, but you're free to do that. It's not a problem. We're a small group, right? All right. Couple more things. We have about 4 minutes to go, and I don't want to keep you too late. And that is idea of net realizable value. This is the idea that sometimes, this is usually on a downward adjustment, is sometimes less than what we expect it to be based upon original cost. And so it's essentially what it would be worth now if we were going to convert that asset in the ordinary course of business. This ordinary course of business topic is important because what we're really talking about here is we're saying under ordinary circumstances, this is what we would expect to happen, right? But it also applies to revenues and expenses. And that is, under ordinary courses of business, this is what a revenue is. If I sue somebody and give a judgment, that's not, unless I'm in the business of suing people, which most companies are not, although you might not know that, then that's something that's a one-off. That's not really something that is the ordinary course of business, which is why we have a different treatment for that sort of thing. So it would not be considered a revenue. So, and the same goes with valuation of things which are not necessary assets or liabilities or balance sheet items, particularly that are not usually valued in the ordinary course of business. Current cost, what it would be to purchase or reproduce the asset, and then the present value, which is the idea of using discounted cash flows, which we got into a little bit of business 1180. We didn't really get into it too much in 2110, but here's where we're sort of going with this, and that's this idea of fair value and how we represent fair value. And fair value, which used to be called current market value or fair market value. And by the way, this term has got all kinds of different representations: fair value, fair market value, current market value, whatever. But it's basically what is the value of this particular thing right now. Usually a balance sheet item like an asset or liability. We think of it, I think, more of assets, frankly, but it's what can we receive if we sold the asset right now, or if we got rid of a liability. In other words, these are balance sheet items. And what would they be worth now? And there are 3 different approaches and they all have different sorts of reliability, and they sort of go downward in terms of reliability. Number one is the market approach, which is based upon primarily quoted asset prices. And we're thinking, I mean, things about, things that we can get our arms around, we can look at very quickly. Or income approach, which is estimated future amounts, converting those to a single present value. Again, this is a little bit more tricky because we're talking about something which is future cash flows, trying to convert it. That's a little bit different than just simply pulling up something as a current market, like what is the value of a bushel of corn? I can give you that information right now, right? But if I can't get that, I've got to use other methods. One of those is the income approach. And the other, which is even more reliable, unreliable, is, or less reliable, I should say, is the estimate, the amount that we're required to buy or construct those assets. And that becomes even more difficult. And so the reliability factor really sort of goes down. But there are a lot of assets that are difficult to value. And I think back to the financial crisis, 2008, 2007, 2008, around that time, when we had these instruments called credit default swaps that there was no ready market for. And yet they were a big, big factor in the financial collapse of a lot of banks and whatnot. Well, what are they? And I have to say, by the way, I've been involved in the financial world for a long time. I had never heard of that term before. I didn't know what it was. And by the way, if you think that I'm sort of out to lunch, the Federal Reserve Chairman didn't know what they were either. He had to have bankers explain what they were. And that is, there was no ready market. So you could not value those easily. And that becomes difficult because that's the job of accountants, is to value things. But how do you do it when there's no easily referable source to get that? Okay, so it's difficult, and we'll talk a bit more about fair value as we get going. So we're out of time. Just turned at 11:45. So are there questions before we turn off this today's class session? Okay, when we come back on Tuesday, I just want to finish up this a little bit. I don't want to spend a great deal of time on it because I think it's not particularly technical at all in a lot of ways. It's I think fairly easy reading, so I'm going to leave you to your own devices. I will cover some of that, but I do want to jump into chapter 2 next week, because it gets us into more of the rhythm of what we're doing in this course. If you have difficulties with with accessing Connect and the work to be done there, or the text itself, which is also in Connect, let me know. Just send me an email or stop by. I'm here every day, and I'm more than glad to help you and try to figure out the problem. I am here to help. I really am, and I want to make sure that you are able to succeed. Okay. All right. Well, have a great weekend, everybody. See you on Tuesday.
Thanks, Jeff.
Okay.